Hey everyone, welcome back to the channel. Today, I want to walk you through exactly how I approach investing using two different types of accounts. One focused on long-term growth and one designed to generate income and take strategic risks. These aren't my only accounts, but I wanted to give you all a view and a potential simple setup you can use for yourself if you choose to. Interested? Stick around for more. Welcome back. It's Rico here. Before we dive in, this is not financial advice. I'm just sharing what works for me based on my goals. Always do your own research and invest based on what makes sense for your situation. I am not a financial advisor, just the guy on YouTube. Also, if you love portfolio breakdowns, let me know in the comments down below. Do you want to see a deep dive into my long-term growth portfolio or my income portfolio? Drop a comment and I'll make that video next. All right, let's get into it. I keep my investments organized in two main account types, each with a specific purpose. This helps me maximize returns, reduce taxes, and balance risk and reward. I call this my two-account strategy. Yeah, no witty, interesting, punny name. I call it like it is. Keep it simple. Okay, so the first type of account are my tax-deferred accounts. This covers accounts like 401ks, Roth IRAs, traditional IRAs, and if you have other accounts like 529Cs for your kids' college fund, I have a whole different strategy for that, but we'll save that for another video. Comment down below if you want me to share my hidden secret to maximize tax, participate in insane growth, and you won't get penalized for early cash outs on a 529C. Let me know if you want to see that. Okay, back to the tax deferred accounts. These are my nest egg, my prep for the future. I don't touch them. Since I'm still 15 to 20 years away from even thinking about Social Security, this is where I focus on long-term steady growth. These I call my steady Eddie accounts. ABI, always be investing, and watch these compound and grow. So why do I use tax deferred accounts for long-term growth? Well, one, tax benefits. In a 401k or traditional IRA, your money grows tax deferred. In a Roth IRA, withdrawals are tax-free in retirement. I prefer the Roth IRA because I paid current tax rates on the current value. As these accounts grow and as time goes on, taxes tend to increase and inflation eats away at the value. So this is my way to grow without those burdens, since stocks typically grow with at least the same as inflation, if not more. The next reason why is compounding power. The longer you invest, the more your money grows exponentially. This is why time in the market beats timing in the market. I'll go over this in a bit more in a second. This is the secret to building true wealth. And then finally, this prevents emotional mistakes. Since withdrawing early comes with penalties, it forces you to stay invested and ride out market fluctuations. Never catch a falling knife, and for many of these growth indexes I'm using in these accounts, they show an average of 7 to 10% growth year over year, which includes recessions and down years. So you'll win eventually, right? Okay, now the power of compounding over time. So let's say you invested $10,000 into a long-term account like a Roth IRA and let it grow at an average of 7% annual return. So we're gonna look at two scenarios. Scenario one, no additional contribution. So in year one, if you invested $10,000, you get a 7% return of $10,700. Have $700. What do you have? Year 5, you'd have $14,025. Year 10, $19,671. And in year 20, without any additional contributions, you'd have $38,696. That $10,000 income or investment nearly quadrupled just by leaving it alone and letting compounding work its magic. Okay, now scenario 2, consistently investing $200 per month, or if you had a $200 dividend that was reinvested each month. Now let's say instead of just investing once, you decide to add that $200 per month to this account. So say you invested $10,000, $200 dividend reinvestment every month. So after 20 years, you would invest $58,000. That's kind of a lot, but your final balance after 28 years, $121,287. That's an extra $63,287 in compound interest. So you more than doubled what you actually put into it, and you didn't have to do anything. So you can see how setting it and forgetting it can really create more wealth. Imagine this with $50,000 or even $100,000. How much more money could you have? Okay, now let's talk about what I invest in this type of account. Keep in mind, this isn't fully comprehensive, but just to give you an idea of my holdings in these tax deferred accounts. So one, growth ETFs like SCHD, VGT, VOO, VTI. This gives me great broad market exposure with strong historical returns and, minimal dividends. At least they're reinvesting. And long-term individual stocks like Nvidia, Intuitive Machines, Energy Transfer, Agree Realty, and Amazon. These are companies I believe will continue to dominate their industries for decades. I have more than just these individual holdings, but again, this is just to give you an idea of what I keep in this portfolio. If you want a full breakdown of this portfolio, like I said earlier, drop a comment down below. Okay, now my second kind of account, the taxable brokerage account. These are accounts like Robinhood, Webull, or any other retail trading platform. Yes, they have IRAs and other offerings, but I like to have an account that I can liquidate quickly if I need to. And this is where I get more hands-on with my investments. The goal here is cash flow and financial flexibility. So, why do I focus on income here? Well, a few reasons. One, there's no withdrawal restrictions. Unlike 401k or IRA, I can access my money whenever I need it. This is as liquid as you can get while still having strong returns. If you're still using a savings account at a big bank, you definitely need to rethink your financial strategy. I'm not giving you advice here, but I'd rather have 7 and 10% returns on my money instead of 0.01%. Wells Fargo. Sorry. Next, passive income. It replaces my W-2 income. So as a semi-retired executive who mostly now mentors, coaches, and volunteers, my goal is to have my investments pay me instead of working for my paycheck. I spent too much of my early years working and making others wealthy. Now I'm doing it for myself on my terms. And then finally, flexibility for opportunities. I can invest in higher yield dividend stocks, covered call ETFs, REITs, BDCs, without worrying about early withdrawal penalties. Yes, these can be riskier, but that's why these accounts are more actively managed by me. All right, so what do I invest here? I got into this a little bit in the last section. High yield income ETFs and dividend stocks. So SCHDs in this portfolio, but things like JEPQ, QQQI, SPYI, QDTE, XDTE. These are generating consistent cash flow every month to the tune of about 8 to 12%. Higher yield alternative income plays like BXSL, which is a BlackRock BDC, Rhythm Capital, Yield Max ETF like MSTY and NVDY. These definitely boost my monthly income, but need to be monitored and managed a few minutes a day. Small overhead to bring in $7,000 to $9,000 per month. I'm willing to do that work. I also like to invest in individual stocks with high dividends. Things like Energy Transfer is a good example. A solid play that pays over 6% in dividends. And then finally, this is my stock playground. I like to play in here. I use this account to test out new investments before going all in my tax deferred accounts. I was able to test Energy Transfer, Intuitive Machines, Nvidia, Tesla, Agree Realty, and a few more stocks early in my investing career. And those stocks gave me huge returns that I mirrored in my tax deferred accounts. I love the strategy because I can stay invested tax-free, then migrate my active investing to new up and coming stocks to continue the income snowball. I love this strategy. If you can tell, super passionate here. So as you can tell, I prefer high dividend yield stocks, typically in the 6 to 12% range, because if you structure it correctly, you can create a strong, sustainable income portfolio with these types of investments. They do have risks, so again, not financial advice, do your own research. But not all 12% dividend yield stocks are yield traps. Let me know in the comments below, once again, if you'd like to see this full portfolio. Whichever account type gets the most votes, tax deferred or taxable, I'll make that one of my future videos. Now, let's get into the pros and cons of this strategy. So, pros, why this works for me. So for one, it's a balance of growth and income. My retirement accounts grow for the future, while my taxable accounts pay me right now. I can plan and rest assured that I have funds for every stage of life. Next is tax optimization. Growth investments stay tax advantaged, and I only pay taxes on dividends and income when I need them. It's having a paycheck without the boss. Can't really beat that. And also keep in mind, not all dividends are taxed as normal income, so there's some tax optimization in that regard too. Next, risk management. I take long-term bets in my 401k and Roth IRA, while using my taxable account for higher risk, higher reward opportunities. And passive income. My taxable account generates $7,000 to $9,000 per month in dividends, covering a huge portion of my living expenses. You don't know how much freedom that creates for me. All right, so cons, these are things to watch out for. More management. I have to keep track of more accounts. The tax rules, investment strategies take time and effort. I spend at least 30 to 45 minutes a day researching, checking up on, and in some cases, rebalancing my active portfolio. Sounds like not a lot of work, which isn't. I actually enjoy it, but to some, maybe that's a deal breaker. Market volatility is a con. My taxable account is more volatile because I take short-term bets and not all of them win. I've been lucky, but I reinvest some of my dividend income into more diversified, less volatile ETFs to hedge against some of those risks. And it's taxable. Dividend income is taxed, so I have to plan accordingly. But remember, not all the dividends are created equal. Capital returns, for example, are taxed at a much lower rate than ordinary income. So definitely keep that in mind when you're an income investor and you're living off dividends. So how should you think about this strategy? Well, it depends on your stage of life, your investment goals, and how aggressive or conservative you want to be. For example, young professionals, you can start early, even with small amounts, putting $100 in every month, every week, whatever you can afford. Prioritize your tax-deferred accounts also when you're younger, so you can put more into growth. And then focus on learning. Learn as much as you can about stocks, income investing, growth investing, and what your goals are. For those mid-career professionals out there that are like me, I wanted to maximize my retirement contributions. So I always maxed out 401k, all the matching, IRAs, etc. I also started exploring income generating investments. That's how I got to where I am today. And now my goal is to build a balanced portfolio of income and growth. And then for those that are near retirement, you want to shift more towards stable income producing investments, things that are less risky but have reliable dividends. You also want to consider the tax efficiency of some of these accounts that you're going to use. And one of the other things you have to plan for is healthcare and lifestyle costs. When you're retired, you have to rely on government subsidies. If you retire early, you got to pay out of pocket. So those are those are certainly things to consider. So that's it. That's my 2-account investing strategy. So are you more focused on long-term growth, or do you like generating income now? Drop a comment below. Let's talk about it. I want to have a conversation. I'm trying to balance both. So I live off dividends, but I also invest for growth. And again, if you want me to deep dive into my long-term portfolio or income portfolio, make sure you let me know in the comments. The one that gets the most votes will get that video shot. If you got value from this video, please hit the like button, subscribe, and turn on that notification bell so you don't miss out on any of my other breakdowns and other investment strategies. Thanks so much for watching. If it doesn't challenge you, it doesn't change you. Take care, and I'll see you next time. Peace.